All right, Michael.
Thank you.
Yeah.
Okay, we're gonna have Beth come up and Dan I. We're gonna have during the Q&A, we're gonna have 4 microphones in the audience, and as I mentioned, Dan is our head of asset allocation and equity research. Beth is a senior financial advisor and certified financial planner. So any questions you have regarding the market, GDP, religion, politics, sex.
You can answer that one.
Financial planning. Wait a minute, there's 3 of those things we're not going to talk about. So you figure that out. So we've got Daryl with a mic, Chris with a mic. We've got other mics here in the audience. Anyone have a question? Question. We have a question right here.
Happy anniversary.
Thanks, Ed.
Thank you.
A couple weeks ago, the president or CEO of BlackRock announced that his firm was going to take environmental impact into consideration when making investment decisions and when voting on corporate proposals where they had investments. So maybe the quick summary of how you make your decisions, and is that something you might take into consideration in the future?
You're asking if we see corporations making decisions based on environmental aspects, does that play into our evaluation of a company?
Or your evaluation of the environmental impact of a company, whether or not you might or might not invest in it. Such as like IBM announced it was going to invest $1 billion to go not only carbon neutral, but to recover all the carbon it ever emitted over its entire life. I mean, would you not invest in a company that you thought was good because it was a giant polluter, for instance?
Dan, you want to take that?
Yeah.
Sure. Yeah, I think what was kind of interesting about Larry Fink's comments and his letter was also a I don't want to say admission, but he fully recognized that he's kind of beholden to ERISA guidelines as well, which means the objective of maximizing return for a unit of risk for their investors, and I think that should probably be the core focus of an investment manager, and corporate CEOs that are really the stewards of the corporation's capital and focus on shareholder returns. So not to say that environmental concerns shouldn't be at the high end of that list, but the focus needs to be on maximizing returns for shareholders, in my view.
Yeah, that's
Thanks.
absolutely the way.
Thanks, Dan.
Yeah.
Question? Any over here? Over here? Okay, it's going to be a short Q&A. Okay. We do have a question over here. Catherine.
So why do you think the coronavirus is affecting the market?
Why do we think the coronavirus is affecting the market? Charlie, coronavirus? Have any of that?
Yes, I don't have the virus myself, Mike.
Okay.
Just let me clarify that. Historically, when we do see an event such as SARS or any of these virus outbreaks that's happened historically, it doesn't necessarily roil the markets for a week or two, but if you look at the historical pattern, if it does affect the market at all, it's a very brief episode. And I would submit that today the technological advances and the ability of the pharmaceutical companies to come up with an effective virus inoculation to the virus in a very short time frame is going to make these episodes less and less of a concern for the markets. Bottom line is, I don't think it's a big deal for the markets.
Thanks, Charlie. Wiley? Wait, you have a question here? Mike? We need the mic on. Wiley, what's your question? And I'll repeat it.
Culture, man.
Here's the question. The question is, of all the financial advisory firms out there that we could have merged with, why Roof? Why Harrisburg? Is that a fair question? Okay. I'll take it.
Yeah.
Okay. All right. Fort Pitt Capital Group, we're very, very growth oriented. We're not the kind of firm that's a lifestyle firm where the owners kind of go to the golf course every day and kick back and hang out at their Florida house. So we're very growth minded. And we've seen over the years our clients really have supported that by giving us more money to invest and making a lot of referrals. But with our plans for growth, in order to propel that, you need to grow inorganically also by doing mergers. So we believe that growth is good. We have a lot of ambitious employees who want to move up in the firm. Providing that growth is a very good idea. We wanted to expand our regional footprint. We were introduced to Jeff and his firm through an intermediary. We hit it off. We see the opportunity in Central PA, which reaches us into Baltimore, Washington, Northern Virginia, Philadelphia. So it just made a lot of sense for us to grow inorganically through this merger. And it's, as you've heard, it's worked out really, really well.
I would add that it's all about culture. We found a culture that was compatible with the one that we'd built, client-centered. As Mike said, Roof is not a lifestyle firm where the owner's absent. Jeff is in there. He's working. Everybody's working there. And that culture is one that we could relate to.
And I would just add too that that the culture aligns really well, as does the investment process, the way we structure portfolios, the way we think about the world. I know Charlie's emphasized the value-oriented approach, which is one that we've maintained throughout the years as well. So we think it's the perfect fit as well.
Thanks. We have a question right here, Don.
I've been hearing in the news that the Trump administration is looking at lowering taxes again. Do you think that's feasible, and how do you think that's going to affect the market?
Absolutely, it's feasible if the Republicans win back the House. That's the only way that it's feasible. So one is sort of a precondition for the other. So I think that's what he is trying to promote, the idea that, hey, I'm going to offer up a middle-class tax cut if you go ahead and vote for the Republicans in November. That's the way he's trying to serve it up. So one's conditioned upon the other.
Santo, you have a question over there? Bill?
How many of your clients are retirees?
I didn't hear it.
How many of our clients are retirees? The answer is a lot. I don't really have the percentage that are retirees, but it's a lot. Yeah. Darryl, we have a question right. Oh, Chris, we have a question right here. A couple more questions.
A couple of factors. I wonder to what extent they weigh in your evaluation of different stocks. That is the relative difference between U.S. and international economic growth and interest rates. And the other is inflation, if any.
I can take that one, Mike. We're weighing value across every geography. If we can find a good business that we can understand that's based in the U.S., we will own it. But investing overseas, there are several more variables involved that we really don't necessarily want to deal with. They include currencies, politics, financial reporting, So we don't claim any expertise in investing in foreign companies in our individual stock portfolios. So we let the managers in our mutual fund asset allocation portfolios provide the foreign exposure in our managed accounts. So we divide the labor and we let the people who are good at it, the folks who are on the ground in these other countries and know these companies the best, pick the investments for us.
Back here, Catherine. Yep.
Hey, Mike, I have two questions really quickly. The first, if you think that the S&P is going to decline 7% throughout the year, which sectors or companies are you focused on for value this year? And a second, almost unrelated question, how do we feel about Boeing's ability to get past the 737 MAX issue?
Let me take the sector stuff and.
Sure.
Okay.
Dan, you take the front, and
Yeah.
Charlie, you take the Boeing.
Sure.
That sounds like a good division. I'd say when you look at sectors exposures, the one sector that we really like is healthcare. Reasonable valuations, really good growth prospects. Has some defensive characteristics as well. So that's a sector that we really like. And an issue with the broad market, as Charlie's talked about, would be high valuations, certainly compared to history. If you look at financials, financial stocks, valuation is not an issue. It's not an area where we have a lot of concern. There's sector trades that call it 12 times earnings versus 18 or 19 for the S&P. Financial stocks have very strong balance sheets, are returning a ton of cash to shareholders in terms of stock buybacks and dividend yields. So that's another sector we tend to favor. I'll let Charlie cover the Boeing part of the question.
Boeing's one that I've already gotten half a dozen questions on, and I can answer pretty briefly. We believe the 737 MAX aircraft will fly again without the need for a redesign. That would be the stake in the heart of Boeing. If they were forced by the FAA to completely redesign the 737 aircraft from the ground up, that would be an expense to Boeing roundly in the $50 to $60 billion range. And that would be something which would impair the business probably for the next 4 to 5 years at least. So, and we believe the odds on a redesign requirement from the FAA are less than 4 or 5 in 100. Very, very low odds.
But we're gonna wrap up with one more topic. If you have additional questions, just see any of us. We'll be glad to answer those. There's a lot in the news now about the Secure Act, which is going to impact everyone in this room who has retirement funds and IRAs. Beth Lynch is just going to give us a little bit on the Secure Act. We're going to have to be talking to each of you individually about how this affects you and your family.
So the Secure Act was passed by the president, signed into bill in late December, and kind of passed through with other things on the agenda. It was going back and forth between the House and the Senate as to what was going to be into the Secure Act. With it came a couple really big things that affect probably everyone in this room. That is the death of the stretch IRA. A lot of us made sure we put our beneficiaries, have named them, talked to our estate planning attorneys, and planned for that IRA to go through generations by allowing us to stretch our IRAs to our children and let them take out their distributions over their lifetime. That will now go away, and anyone who passes away in 2020 and leaves an inherited IRA to a non-spouse will be required to take that distribution out over 10 years. They can pick how they take it out. They can take it all out in 1 year, but it has to be distributed by year 10. So there's going to be a lot of planning for children who are inheriting that. Those children inheriting could actually be in very high tax brackets, high earning years. So to strategize how you take those distributions so that you're not being put into a higher tax bracket will be important to work with your advisor and your tax advisor. The other area is the 70 and a half. So the IRS moved the required minimum distributions from age 70 and a half, which everyone had a problem calculating their 70 and a half birthday anyways, to age 72. If you turned 70 and a half in 2019, sorry, you still have to take your required minimum distributions. If you turn 70 and a half or in 2020, you can delay that required minimum distribution to 72. But that does not mean you have to. Again, talk to your advisors. Because of being the depth of the stretch IRA, there may be reason to still make those distributions from your IRA. And the third big point is qualified charitable distributions. This is not going away at 70 and a half, even though RMDs changed to 72. You will still be able to do qualified charitable distributions from your IRAs up to $100,000 per person for your IRA to a qualified charity, and that it's not taxable. So it's a great way to get money out of your IRA and give it to a charity of your choice without being taxed on it, which helps with Medicare premiums, premiums, your Social Security, taxation, and a variety of other things. So be sure to talk to your advisors and have them get together with your estate planning attorneys and your tax advisors to build a strategy that works for you.
Great. Thanks, Beth. So, as Beth just described, some good stuff and some really bad stuff, but we will help you figure it out as best we can. Thanks, everybody. On behalf of Charlie, Ted, all of us, thanks very much. Appreciate it. Thank you, Arlene Hobler.
Yeah.
We'll see you all next year. Have fun.
Thanks, Dan.
Stu. Chuck.